Did you know that over 55% of Brits are completely unwilling to invest their savings in the stock market? Welcome back to Quiet Wealth. Hi, I'm Amara. I'm a former investment banker turned financial educator, and on this channel, we focus on playing the long-term wealth game rather than the highly visible status game. Today, we are breaking down the 4 massive investing lies that are keeping the British middle class broke in 2026, and I am going to show you exactly how to replace those lies with the silent, unsexy habits of the quietly wealthy. What is even more shocking is that 65% of those people say they avoid it simply because they believe it is far too risky. I'm here to help you navigate the UK market by leveraging your existing professional skills into a stable portfolio career. From boring B2B side hustles to the psychological frameworks like implementation intention needed to actually launch them, we're building wealth without the noise. If you have ever felt like the stock market is just a playground for the rich, or that you need a finance degree to understand what is going on, you are not alone. But the truth is, you are likely falling for a set of carefully disguised myths that are quietly destroying your financial future. Let's dive straight into the biggest lie of them all, which is that investing is just gambling. When you turn on the news and see markets crashing, or you scroll through social media and see crypto prices skyrocketing overnight, it is incredibly easy to feel like investing is basically walking into a casino and putting your entire life savings on black. You put your money down, the numbers flash red and green, and if you are lucky, you double it. But if you are unlucky, you lose the lot. It is no wonder so many people are terrified. But here's why that mindset is keeping you poor. Gambling is entirely based on luck, and the odds are mathematically stacked against you because the house always wins by design. Investing, on the other hand, is completely different. When you invest, you are buying real pieces of real businesses. You are buying into companies that make actual products, employ thousands of people, and generate real profits over time. Those profits drive your returns and are passed on to you in the form of dividends and rising share prices. To prove this isn't just a theory, let's look at almost 100 years of data on the US stock market analyzed by Schroders. Their research found that if you invested your money for just 1 month, you would have lost money 40% of the time in inflation-adjusted terms. But the longer you stay invested, the more the odds shift dramatically in your favor. If you leave your money invested for 5 years, the chance of losing money falls to 22%. At 10 years, it drops to 13%. And over a 20-year period, historically speaking, there have been absolutely 0 periods where large-cap U.S. stocks lost money in inflation-adjusted terms. The media loves to report on terrifying market crashes because negative economic news gets more clicks, but they rarely report on the quiet, consistent recoveries that follow. The quietly wealthy know that investing isn't gambling, it's simply letting time do the heavy lifting while the global economy grows. That brings us perfectly to the second massive lie keeping you poor, which is the belief that you simply do not know enough to get started. 41% of Brits say they don't invest because they don't understand how the stock market works. Many of us assume that to be a successful investor, you need to spend your mornings aggressively reading the Financial Times, analyzing complex spreadsheets, and trying to spot the next massive tech winner before anyone else does. But I want to tell you a quick story about a ginger cat named Orlando. Back in 2012, the Observer newspaper ran a competition to see who was best at picking stocks. They gave 3 contestants an imaginary £5,000 to invest over the year. The contestants were a team of highly experienced professional money managers, a group of smart high school finance students, and Orlando the cat. The professionals meticulously analyzed the markets, the students did their research, and Orlando the cat picked his stocks by simply throwing a toy mouse onto a grid of numbers allocated to different companies. By the end of the year, the students had lost money, the professionals had grown their portfolio to £5,176, and Orlando the cat had beaten everyone, finishing with over £5,500. This story highlights decades of genuine academic research, proving that even experienced, highly paid professionals consistently struggle to beat the market. In fact, over the last 15 years, over 88% of actively managed funds underperformed the S&P 500 index. This is actually incredible news for you and me. It means you absolutely do not need to be an expert to build massive wealth. You do not need to pick winning companies. Instead, the quietly wealthy use broad global index funds, which allow you to buy a tiny piece of hundreds or thousands of companies all at once. Rather than trying to find the needle in the haystack, you simply buy the whole haystack. It's incredibly boring, completely unsexy, and wildly effective. The biggest risk isn't getting it wrong, it's doing absolutely nothing because you are paralyzed by the fear of not knowing enough. Now let's tackle the third lie, which is perhaps the most insidious. I don't have enough money to start investing. According to a major study, over half of the people who don't invest say they just don't have the cash, and 1 in 4 people actually believe they need at least £10,000 before they can even take their first step. When we picture an investor, society has conditioned us to imagine someone in a tailored suit managing a massive 6-figure portfolio with exclusive insider knowledge. It feels like a private club that you're only allowed to join once you're already rich. But that's a complete myth, especially today. Thanks to modern investment apps and fractional shares, you can legitimately start investing with as little as £1. There are no gatekeepers, no minimum balances, and absolutely no need to wait until you're wealthy. The mathematical truth of wealth building is that compounding rewards time far more than it rewards large amounts of capital. Let me give you a concrete example of how powerful this is. Someone who starts investing just £50 a month at age 25 will likely end up with significantly more money by the time they retire than someone who waits until they're 35 and invests £100 a month. The person who started earlier invested less of their own money out of pocket, but because their money had an extra decade to compound and grow, they easily win the wealth game. The quietly wealthy know that you don't wait until you're rich to start investing. You invest so that you can eventually become rich. The key is to start exactly where you are, right now, even if it's just a few pounds a week. Build the habit of automating that money into your stocks and shares ISA first, and the big numbers will eventually follow. And finally, the fourth lie that keeps the middle class trapped in the rat race is telling yourself it's too late for me to start. I hear this all the time from people in their 30s, 40s, and 50s. When someone tells me it's too late, what they're really doing is disguising their regret as a final, set-in-stone verdict. They look back at their 20s, a time when they were likely struggling with entry-level salaries, trying to get on the UK property ladder, or paying for weddings, and they beat themselves up for not investing £500 back then. They run a compound interest calculator, see that they could have had £80,000 by now if they had just started earlier, and the regret paralyzes them into doing absolutely nothing. The torturing yourself over the past is a terrible financial strategy. The reality is, by the time you reach your 30s or 40s, your earning potential is likely much higher than it was when you were 22. You're probably more established in your career and more financially stable. This means you can afford to invest a slightly higher amount each month, which makes a massive difference in catching up. If you start today with £200 or £300 a month, you can still build a portfolio worth well over £100,000 in the next 15 years. The time is going to pass anyway. You are going to be 10 years older whether you invest or not, so you might as well arrive at that future date with a massive investment portfolio backing you up. The biggest mistake is never that you started late. The biggest mistake is choosing not to start at all. Escaping these 4 lies comes down to a fundamental shift in how you view your money and your time. The quietly wealthy prioritize their time over price. They know that trying to outsmart the market is a waste of their valuable energy. Instead, they automate their investments into boring index funds, accept that the market will occasionally dip, and get on with enjoying their actual lives while their money works silently in the background. If you've been using any of these 4 myths as an excuse to put off your own financial freedom, let today be the day you finally change the narrative. The best time to plant a tree was 20 years ago, but the second best time is absolutely today. If you found this video helpful and you're ready to stop playing the status game and start playing the quiet wealth game, please like this video and hit that subscribe button right now. Thank you so much for watching, and I'll see you in the next one.